Oh man, we are going to do the dividend debate. Now, a lot of YouTubers like dividends. I completely understand why. And a lot of people that are in retirement actually rely on dividend income to supplement their retirement. Are dividends just a marketing tool? Now, to be completely transparent, I don't care about dividends. I care about total returns. At the end of the day, your brokerage account is the scoreboard. So whether you're a dividend investor, whether you're a growth investor, or whatever kind of investor you are, your brokerage account is the true scoreboard. And if you're benchmarking it against a major index and you're outperforming something like an S&P 500, or if you've been lucky enough to outperform something like the triple Qs, then you're probably doing just fine. Now on this channel, I always recommend just buying a broadly diversified index, set it and forget it. But we all know we like waking up and getting those checks in our account. So in this video, we're actually going to watch a very, very important debate and something I want you guys to stay focused on. Stay focused on the facts here. Now, dividends are very important to overall stock market returns. When we look at the history of the US stock market, dividends make up roughly 30% of total returns, which means that nearly 70% comes from stock appreciation. Now, if we just go through the history of the stock market dividend yield, we can see that it basically paid 3% consistently from 1871 to 1960, which means that if we're talking about a 10, 11% stock market return, we only needed about 7 to 8% stock appreciation and reinvesting that dividend in order for us to get a total rate of return of around 10 to 11%. And we could see 1999 to 2001, the dividend yield was low. And we could see from 1970 to 1990, we had a 4% dividend, the highest yield we've seen on the S&P 500. Now, a few things are actually going to come into play here. Number one, where was the overall price on the S&P 500? As prices go down, yields go up. And number two is, how was the S&P 500 diversified? Back then, I imagine it was a lot of oil companies, electrical companies, and companies that normally give their biggest return through a form of a dividend, hence why the S&P 500 had a higher dividend yield. Now, currently we have a historically low dividend yield sitting at 1.2% and a high PE ratio, which to me is signaling that we are overvalued in multiple ways. If I'm truly focused on yield, I can obviously get yield somewhere else with a lot less risk, but there was a really good debate on CNBC that I think most dividend investors need to listen to.
Ringing the alarm of sorts on being invested exclusively in one stock strategy. Josh?
Suffice it to say, you had 15%-ish average annual returns for the S&P 500. The NASDAQ obviously substantially higher. And you find a lot of people who got back into the market after the great financial crisis or sometime thereafter, but they allocated so heavily to the dividend factor that they really missed out on a lot of what else drives market performance. So I am pro-dividend. 75% of companies in the S&P 500 do pay a dividend. But when you actually analyze it as a standalone factor, 54% of the time, it trails the performance of the S&P 500 over all 12-month rolling periods going back 30 years. So I think when you look at the way companies are now allocating capital, you go back to 1993, on average, companies use 36% of their retained earnings to pay out dividends. That number is pretty constant. What's changed since 1993 is that the cash used for buybacks has gone from 17% to 71% of all corporate cash, and that buyback strategy is a thing that companies are doing in response to the fact that it's a better deal for stockholders.
So I think Josh Brown is actually making some very, very valid points. You have to look just beyond the dividend. Buybacks are the most efficient way to return capital to shareholders. With dividends, it's a double taxation. The corporation pays taxes on the dividends, and then you pay taxes to receive those dividends in your brokerage account. Not the most efficient way to return capital. Now, if you're an individual stock picker and you are a dividend investor, I really think in order for you to keep up with the market or outperform, you have to be using options here. Now, as I stated earlier on in the video, I always recommend just buying a broadly diversified index, set it and forget it. Pretty hard to beat the overall indexes, especially if you've been a dividend investor over the last 5 years. There's multiple companies that I can name that are down 30, 40%, and their dividends are now really high, which is kind of a dividend trap. We won't get into that into this video, but I want to stay focused on the topic here. Now, if I was using a dividend strategy as far as income goes, for me personally, I would look for a decent yield, company that still has the ability to grow earnings, the payout ratio is really low, and I would be writing covered calls against those positions to add 1 to 1.5% every additional month of owning that position. Most high dividend paying stocks, the stock price doesn't move a lot. You're not going to get a tremendous amount of stock appreciation. The majority of your gains are going to come in the form of a dividend, so you have to create more income by another metric. Now, dividends come in the form of company profits. If a company is not growing profits, they're probably not going to grow their dividend, and if they are growing their dividend, I can assure you that that dividend is going to be in question going forward. So that payout ratio is extremely important and should be one of the top things you look for when you're buying a dividend stock. Now, a distribution from a dividend comes from corporate profits. If I own a stock that trades at $27 a share, and let's just say it pays out a crazy dividend of $1 a share. When I wake up the next morning after that dividend payment, I now own a stock that's $26 and I have an additional $1 of cash to deploy. Now, with market pullbacks, dividends really help you invest at a lower cost basis, which then when the stock appreciates, you own more shares at a lower basis, which should actually compound your portfolio. So there obviously is a bonus to having that yield in your portfolio. But once again, total returns are going to be the key metric you want to look at. Companies that I look at that I think could be a little bit better when it comes to dividends, once again, I'm not trying to pick on them, but it's Verizon. Verizon should be paying down debt. The dividend shouldn't be as fat as it is, because if it paid down debt and actually bought back stock, you would see tremendous stock outperformance on this company and free cash flow would be enormous in this company. But instead, they carry a tremendous amount of debt, and this costs a lot of money to carry this debt. So therefore, the business is not running as thin as it possibly could. But I did buy Verizon in my wife's portfolio. Reason being is I'm a total return investor, and I ran an analysis on Verizon. And so when Verizon and AT&T were absolutely tanking due to the threat that there was toxic lead cables that were exposed, personally, this gave me a buying opportunity to add some in my wife's portfolio. And so at that point in time, Verizon was paying nearly an 8% dividend. So if I'm factoring in total returns, I essentially need about 4 to 5% with performing up to market expectations with a company like Verizon. So I didn't need a tremendous amount of return on this massive pullback. And if I want to build some safety, I could have gave myself about a 6 to 7% rate of return, add that in with an 8% dividend, and you have some safety built in there. Now, the question was, is that dividend going to be safe? Because the payout ratio was getting very high, which it looks like it's getting under control, but it's definitely something that still needs to be monitored. So I felt like anything around $31 was actually a pretty good deal and made a tremendous amount of sense to add some yield in the portfolio, have something that's kind of boring and safe. But the other thing I can do with this is actually write some calls to add some additional revenue on top of that fat dividend that it offers. So that was personally the strategy that I used for my wife's portfolio. I thought it was a good entry point, and I thought it could have an outsized rate of return if she bought it underneath $31 a share. I think we got in right around $30.80 or somewhere around there, maybe a little over $31 as well. We averaged in a little bit every day during that big sell-off. And so I do think long-term, this is going to be a great buy. I can see the stock rebounding possibly close to $45 or $50 over the next few years and reinvesting that 8% dividend yield. Now, while Josh Brown did beat up dividend stocks, there was another case to this story.
I do, but I completely disagree with you because I think that when you take a look at dividends, you can't look at dividend yield. You have to look at dividend growth, which we've shown through the way that we manage money. In fact, Dividend Aristocrats, the DVY, was up 12% in the US, up 15.5% in Canada. The respective portfolios that we run were up 20% in Canada and 17% in the US. Here's why: because we focus on dividend growth. 60% of the portfolio should always be those core names that have never cut a dividend. 30% should be the names that are growing the dividend, and 10% should be the names that are yields above that. If you're buying companies just because of dividend yield, you can, will, and should underperform. That's what you're looking at in terms of the factor, Josh. I don't disagree. I don't disagree with respect to the yield part of it.
And so I agree 100% with this statement. We've had a hell of a rally in this market over the last, call it 2.5 years. Returns, historical returns, to be quite honest with you. And so there will be a normalization. There will be a day of reckoning. There will be a pullback. And when those days come, dividend investing tends to actually perform extremely well. For the most part, these are lower multiple stocks. They have clean balance sheets. They're pretty boring, and they're mostly in the defensive sector. which we need on a daily basis. So at the end of the day, there is one commonality here. Earnings growth and dividend growth with stock appreciation and buybacks is the absolute perfect formula to dominate in dividend investing. Now, sometimes you get those opportunities on a big price pullback, which will offer a larger yield. And so those tend to be good opportunities as well, even if they are slow growers. But dividends are not magic. They come from profits, and you better deploy them well in order to take advantage of them. And I also think if you're running a dividend strategy, it definitely helps to write covered calls against positions that may have not moved a lot. One of the big ones that I personally think about when I think about dividend investing, and if I were to run an income strategy, Johnson & Johnson is a perfect stock to run an income strategy on. This is a stock price that really hasn't moved a lot over the last 5 years. Premium is actually going to be pretty nice because of how expensive the stock is. And so you can actually create a pretty nice income with a company like Johnson & Johnson, AAA balance sheet. So this would be a strategy I personally would use. So as always, guys, I do see both sides of the story. I do enjoy both sides of the story, and I'm right in the middle. I think you want to have a good balance of high quality companies that you can write calls against, collect a dividend, know that you can go to bed at night and they're going to be just fine. But I also think if you're young enough, it makes sense to possibly go a little bit out on that risk curve and get those high flyers. Just don't make them too large part of your portfolio, because if you're young and you have time, a little bit can go a long way. As always, guys, appreciate your time, and we will see you all in the next one.